Where are there, though, right now in equities, any pockets of values, especially for our viewers, that may be nervous, and rightfully so, about the ultimate outcome of this trade fight?
Well, I mean, we think the trade fight here is providing an opportunity for investors to get into the market on this short dip. I mean, ultimately, the discussion that investors need to be having is the discussion something that's worth fighting for? If we are trying to safeguard the U.S.'s intellectual property, then absolutely yes, and that's a bipartisan issue. If it's really just a matter of shifting global balance of payments, then I don't think it's really an outcome that's going to materially move the needle. But it depends on what we're fighting for. If we're safeguarding property from the U.S., then it's a great outcome. It's going to be a great outcome for the market.
Is it a great outcome for the market? Why? Why is this going to be good for the equity markets?
Well, longer term, I mean, the concern is whether or not China is going to continue to force us to transfer our property to them through some of the investments that we make, force us to, on the other hand, take our intellectual property through their inventions and other things. If that happens, then ultimately it degrades the value of our companies. Protecting that is really at the core of the issue here in this negotiation.
Yeah, about 80 or 85% of the value, intrinsic value of U.S. companies is in intangible assets, patents, intellectual property. So you think that this fight may ultimately play out well in equities because valuations can be protected? Is that what I'm understanding?
Well, I think the important part about valuations here is that we don't necessarily view valuations as being extended at the moment. So there are certainly...
On what basis?
Well, I think oftentimes people look at a PE as a simple way of measuring value, but it is an incomplete way. It's kind of like looking at a book and saying, the cover of this book looks great, so therefore it must be a good book. But what we've seen over the past couple of years is companies have become more service-oriented, incredibly capital light, and they have doubled the cash that they're generating. They've become so much more efficient. When you look at a more complete measure of valuation, such as a price to free cash flow, or even better, how much they're returning to individual shareholders through dividends and buybacks, you see something that is roughly 20 to 40% undervalued.
Well, as Warren Buffett will say, cash flow is everything, right? Cash flow is everything. So on a price to cash flow basis, how are we looking valuation-wise?
So on a price to cash flow basis, we're around 20% undervalued. And it's really because over the past decade, companies have become more efficient, and investors haven't necessarily been paying attention to this.
Why not? Because they look at the cover of the book.
Well, and yeah, I mean, that's
By the way, a lot of people buy books based on the cover.
And people buy stocks based on PEs, and I think that's important. It's not that one is necessarily wrong. It's that we should just take a complete look at the value of these assets.
So what right now, what sectors, what stocks, what groups look particularly tasty on a price to cash flow basis, Patrick?
I mean, technology is an area where the valuations continue to look very strong across any of these metrics. And really, they're sort of the focal point of this increased efficiency. Companies are outsourcing the manufacturing of their products, and they hold the services, the stores at which they're selling stuff through, or they hold the intellectual property, and they really take advantage of this business.
Well, they're outsourcing it to China. And that's the reason Apple got whacked more than the markets on Monday, because people fear the fact that if they can't get their products, or they got to make them somewhere else for more, it's going to compress those multiples.
Well, I mean, what they're doing is they're taking that volatility off their business. So they don't actually own the manufacturing component. So it removes the volatility that would have otherwise been there. So they will continue to collect that fee. The phones are going to be delivered. Maybe they'll be delivered a couple weeks later. But at the end of the day, the consumer is demanding that new phone. So the sale will be there.